Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
G'day, how you going? Phil Tarrant, co-host of Property Investing Insights, recording with our good friends over the Right Property Group, Victor and Reshmi Kumar, joining us in the studio. I heard the introduction because I have headphones on. They don't. They probably think of what was I waiting for. But much like the property market, we're all waiting for something to happen. Victor, how you going? Good to see you. Reshmi, it's
Hello.
always good to see you in the studio. You guys been well?
Been well.
Yep.
Yeah.
Very
Anything
good.
to report? Anything going on? Any sort of updates? Any?
No,
I haven't killed him yet, so all good.
No, it's, no changes to things that.
Yeah.
That's,
No, I'm actually going to lead with an apology.
Okay.
Right? And this apology is actually to my staff.
Ooh,
to my
okay.
work colleagues,
what have you
right?
done wrong?
So we're recording this on 1st of April.
Yeah.
Right. And I cooked up this good story in my head that RPG is going to have a change in direction. And I sent an email to the staff saying that Dr. Sloof Lirpa is going to take over RPG and I'm going to step aside. And unfortunately, I played to the emotions of all of my colleagues and it wasn't taken well. So my sincere apologies.
So who is Sloof Looper?
It's April Fool's.
So what you've learned from this experience is probably the idea of April Fool's gag is cool, but maybe
It needs to be thought out a bit better.
It's a good gag, to be fair, but people are probably sort of...
No, I should have sent a follow-up emails or at the bottom said, have a closer look at the name.
Yeah. Anyway, who was first to respond? Was everyone like, what's going on?
Our business coach,
Yeah, okay.
he responded saying, oh, that's a big change in direction. And even he didn't pick it up. So that should have rung warning bells for me. But that something that I can't...
Blame the business coach. He told you
I know,
They
right.
told
Yeah,
you to do
yeah,
it. No, anyway, that's good. It's April Fool. Well, it's past 12 o'clock now. You can't April Fool
I can't
after
April
12.
Fool. That's right.
So I'm safe. You see how I deliberately delayed
I know.
recording until after 12 o'clock, so I couldn't be April Fool's. I completely forgot it was April Fool's. It's a great time, but normally there's some big...
We've had some epic April Fool's shenanigans that we've done with our friends and family.
Yeah.
But I think I'll retire from April Fool's.
I remember seeing once, this being a property podcast, I think the Daily Telegraph or the Sydney Morning Herald had this front page of like, they were going to replicate the Harbour Bridge and have two Harbour Bridge crossings across the thing, and everyone went crazy about it, going, "What's going on?" And then someone, hang on a second, it's April Fool's. So anyway, you have that, you get that, but happy April Fools, everyone. It's, a bit of fun time, but you don't know what Victor does. So I always thought, Reshmi, you always offered smart and considered counsel to Victor, and you're pretty much the
I didn't seek a counsel.
the wicket keeper of most decision making in the Kumar household.
Let me tell you, this was the lighter version that came out with his email. What he had in mind would have been much worse. So I said,
You have too much time on your hands, Victor. It's your problem. You're not buying enough property. Is your problem?
Yeah, you know the saying, idle minds is the devil's workshop.
Yes, this is true. So anyway, well, here we are. This is the third instalment of our special series of Design Your Decade. For all of you who are tuning in, we kicked this off. We introduced it late last year in December. We had a chat around what the plan's going to be and how you can sort of set yourself up and start preparing for it. The crew over at Right Property provided some really good sort of workbooks and background info around it, which I know a lot of you downloaded and started using. It was really a scaffold to help sort of shape those conversations, whether it's you internalizing it or it's with your investment partner. That might be your life partner or someone that you choose to invest in. Really a scaffold for how you go about sort of doing this deep planning. The Kumars, as they shared quite frankly with us, do that over the period of New Year's every year, where they sort of set their stall out of individual plans, and then also how that looks like as a combined approach and how it will shape. Personal plans will shape, therefore, the property planning and decision making you'll make. So we're now sort of pulling that apart over a special series. Here we are on episode 3, and I like the idea of giving our listeners and our viewers architecture to help sort of shape these type of things, because you can get very philosophical and talk around these things, but you actually got to sort of take action as well. So, hard, structured, tactical things to get sort of out. So today we want to talk about the four Ds.
Yes.
Most people think the 4 Ds or 3 Ds in property is like, death, divorce, or debt being sort of like when's a good time to buy. But these are 4 Ds of a different sort of construct.
Different construct. And this is where most people do go wrong, is because there's no structural approach towards investing. And with our years of investing, we found that if you have a firm structure around things and you have a methodical approach, you have a far greater level of success in comparison to if you just meandered your way through property investing, and that way you're lurching from pillar to post without really knowing where you're going. Whereas having this structure and having these check-ins and having these milestones within the portfolio keeps you safe, keeps you away from all the digital noise, keeps you really true to what you're trying to achieve. And importantly, it also gives you a much more firmer platform to then leverage off to the next level of investing as your investing prowess increases.
What I see with a lot of property investors is that they like musing, they like the ideas, they like being creative, they like thinking about stuff, but often that isn't followed up with good tactical outcomes. It gets lost in the way, or they're not able to gather their thoughts in a way in which it gives them a roadmap from which to take action from. So they get stuck in the middle.
Yes.
And you probably see that all the time.
All the time.
Yeah. So these I call architecture or scaffold can really, if you don't know what to do, go back to these points of truth and points of instance, and in many ways, workbooks or a textbook to actually give you a sense for what you need to do and when you need to do it. And sequence is important. Reshmi, you're probably wired that way. I reckon you're a very operationally orientated person.
Yeah, I was just going to say that we've done the book for over 10 years, what you need to do within these 10 years. And if you look at the structure we provided within that time frame, it gives people comfort and keeps them focused in knowing that, okay, this is what I've got to do and this is where I'm heading. So the mind is not jumping around thinking of what my next step should be. It just settles you down and you can just be focused and do what you've got to do, because at the end you've got that result coming for you. So we're saying 10 years as a long time, but it goes very quickly. And if you are not structured within that, it still gives you the freedom. Still 2 to 3 years, we're talking about the mid-years now, where we're talking about the 4 Ds in the middle of your portfolio. And sort of to get to that and then experience those years, it is still a very focused approach, and it goes fast, but it keeps you in line with where you're heading. So it stops you from running out, seeking what else is going on here and there and looking at other strategies. And you can be a little bit more focused if you've got that structure around in those mid-years.
So there's a lot of constructs that people apply to property. We're talking about 4 Ds, and this is to give you, these are the key components to help sort of shape a positive portfolio. A lot of people would look at the life cycle of a property investor, and there'd be a accumulation phase, a consolidation phase, and what's the last phase?
Basically, there's planning, accumulation, consolidation.
Planning, accumulation, and so planning, accumulation, consolidation, and then debt reduction. So 4, So we're talking about pretty much beyond the planning phase, in the accumulation and consolidation phase is where the 4 Ds would apply.
That's right. Yeah. So we sort of halfway through the accumulation, bordering into the consolidation at this stage.
And this is where people pivot from one to another, where you can be consolidating and accumulating simultaneously.
That's right. Yeah. Yes. There's no linear line in there to say, okay, now from this day I'm consolidating. Often consolidation happens in between the accumulation phase to allow your borrowing capacity to rebound, to allow your cash flow to correct before you're then accumulating again.
Yeah, and people got to be comfortable with that idea. With sometimes you're a bit of a metronome. You'll bounce from one to another depending on where you're going. Life changes, all that sort of stuff. May accelerate or decelerate particular aspects of it. So for the purpose of this podcast, we're talking about that period. So you've done your planning. You want to know what you're going to do. So it's in between buying assets and consolidating assets. And consolidation is just not like sitting around waiting for things to happen. Consolidation is where you're working on aspects of your portfolio to make it perform better. So let's talk about the 4 Ds. Reshmi, what are the 4 Ds?
Well, we look at it this way. One of them is diversification, then debt, then we've got direction, and the defense. So we've broken them down in those 4 different areas, and what we've got to do in all those different areas is towards building that strength of your portfolio, how you make that happen.
So are all of these 4Ds contingent to each other, or there is an order to the 4Ds again, or is it sort of a bit of a fruit salad? It depends.
It depends on what properties, how many properties, what type of properties are accumulated to date, and then it also depends on what's also happening in life. Whether you're changing the mode of employment, whether the market is not really in terms of your portfolio itself, whether the market is actually conducive to your age factor, to your capital availability, to your cash flow tolerance. So it does play a role, and sometimes what people do is they get too set in accumulating further properties without addressing the 4Ds, which is at this point in your portfolio. So let's say you've accumulated 2, 3, maybe 4 properties, and it could be year 2 for you or year 5 for you. It's really important that we now address the 4Ds before we actually progress the portfolio. Otherwise, what will happen is that you're forever stuck in accumulation phase, and you are forever stuck in looking at the news to see what the Reserve Bank's going to do in terms of interest rates, not because you're totally reliant on all of the external factors, whereas you want to have everything brought back in to become a self-sufficient tranche of properties within your portfolio to then have reset the platform to then relaunch from there.
So this is a time when you're looking at what am I going to do in order to exit out of the investing. So this is preparation towards an exit. Yeah.
So essentially you want to make your investment redundant because you want out of it at some point, or you want the debt
Yes.
gone
Yeah.
eventually, right? So at a moment in time, you'd look at these 4Ds in isolation, but also comparatively to support the next round of decision making.
Yes.
Okay, that makes sense to me. So let's go through them one by one. The first one being diversification. I imagine this is the portfolio has different sort of assets in it, or is that one aspect of it?
Okay, so that's just one small aspect of it, right? So diversification itself, there's several facets to that. So we're really looking at the operating part of the portfolio and making sure that it's actually, for want of a better word, recession-proof, right? So things that are the moving parts, that's what we need to address in terms of diversification. So really, what you mentioned in terms of, the different states, the different types of properties, they play a big role in that. So certainly we don't want to have everything concentrated in the one state and have that as a sovereign risk or land tax issues and so forth. We also don't want all the properties to be in just the one entity, so that we're giving that diversification. Certainly we don't want the same types of properties or the same overall strategy. So as an example, it could be that you're just focusing on dual income properties. Now, from an investment point of view, that's fairly fantastic. But from an exit point of view in a bad market, it's harder to offload that property because it's not appealing to the owner-occupiers, right? So you need a little bit of diversification there to say, okay, let's put in 1 or 2 houses there that are largely focused to owner-occupiers. It gives us a level of exit strategy out of it. So definitely diversification in that form.
The types of properties in your portfolio, and in units are good ones. Smaller loan, pay them off. Sell them off if you needed to. Offload in situations if you needed to.
There's so many aspects of diversification when you think about it. Type of property, location of property, the lender who's funding or financing it, what entity you have it in.
Yes.
Is it a cash flow orientated property or is it a capital growth type property?
So there's some other diversifications within it, right? So and then you've touched on those, right? So lender is one diversification. You don't want to have all of your eggs in the one basket with the one lender, because not only does it stunt your ability to borrow money, because now all of your loans with that lender are assessed at the assessment rate as opposed to the actual interest rate. So if you diversify your lending across different lenders.
So can you explain that?
So when you go, let's say I'm a bank and you're a bank, right? and Reshmi's taken all of the loans and left it with me as bank one. I'm going to, and my interest rate's the same as yours at say 6.5%. However, going to assess Reshmi's ability to pay at 9.5%, right? Being 3% being the buffer rate at the moment. Yeah. So let's say I had Reshmi had $1 million of debt with me. That's my ceiling over here because I can't get her to qualify for more, right? Whereas if he went with 500,000 with me and the 500,000 with you, you would assess the debt that's with me at the actual repayment rate, or at a slightly higher rate, or maybe at principal interest, and the debt that you're giving at 9.5%. So it automatically increases the borrowing capacity when you have those lender diversification.
Spreads
Spreads the risk as well. In times like the GFC, as an example, there were a lot of loans that were called in, not necessarily called in to pay the whole loan off, but to drop the loan to value ratio down, right? So, and that's a real thing. So we need to, as our portfolio starts becoming bigger, we want to have the eggs in many baskets, and also try and keep our home with the one lender and the investments with other lenders as well. So it gives a little bit more diversification in the sense that, first of all, your borrowing capacity does increase. Your investment ability also increases, and it also allows you to use the different banks' lending policy in your favor, as opposed to just going to the big four, going to the bank that you've always banked and have everything there, which totally stunts the portfolio growth.
Lenders' policy, as you mentioned, one of the things is if a lender is heavily exposed in an area, they will scale it back, and then they may, instead of giving you 80%, they may only lend 70%, for example. So that holds you back as well. So you've got to do your research, because certain areas where the lenders are heavily exposed.
Yeah.
And
so we're talking about loans, right? So there are a few other diversifications we need to do in the loan. So not only are we diversifying the lenders, we need to diversify when each loan is going off fixed, right? So one of our biggest problems, and we talk about, if you fixed, yeah. So as we came into this interest rate climate, there are a lot of people that came in off fixed loans, right? And the natural tendency is you're refinancing everything at the same time, you fixed everything at the same time, so everything comes online into principal and interest, or at the higher interest rate at the same time. Yeah. So you've got a bigger hit at the time in the portfolio, and if you feeling the hit now as a listener on one property, amplify that to 3 properties, that's a far bigger hit, right? So we need to diversify. If you're looking at fixed loans, some variables, some fixed, so that's the diversification. Then you're also diversifying the time the fixed rates expire, so they're not expiring all in the same month, so it gives you the ability to get used to the increased
manage
cash flow.
your cash flow.
That was interesting. Cliff, everyone was talking about
that's
as well,
right?
right? And I know most people, when they refinance, if you're an investor with a largest portfolio, you normally refinance everything at the same time, because it's such a hassle to do it, right? Which has its benefits and merits. The other layer of diversification to that as well is that you don't want all of your interest-only loans coming off at the same time to P&I. So you want that to be sort of spread over a period of time. So there's a lot to think about, really. Like you start at diversification, then you've got these different buckets of loans and structure and property types, whatever, and then each of them has their own layers of diversification. I don't know if anyone's done a mud map on that. Maybe.
It would be interesting to do that, right? So, and then the other thing also is that at this time of the portfolio is generally when you're trying to harvest equity, you're trying to restructure, regroup, and the natural tendency is to have everything expiring at the same time, because it's ease of application, right? So you're just doing the paperwork once, and everything gets refinanced, revalued, and you've got the new interest rate, and it's all really good. But then you're not looking at what's at the end of that cycle, where everything ends at the same time as well.
And it's hard to do that. And I know a lot of investors sit there and they might neglect doing their tax for a little while and be a bit slow, and then they've got to do everything at once. So they do everything once, and they think, oh, God, I've had a really good year, so I want to try and refinance everything now because my service really is going to be better. Yeah. But then what you're doing is clustering everything together, and that has its risk. Yeah, it can have. It's okay and it's really just a lot of it's a cash flow risk, and if you can manage your weather, that's fine. But you don't know at that point in time what's the interest rate's going to be. It's a lot out of your control.
It is.
So these are layers upon layers of diversification. Are the structure things an important one?
It is. Because as you accumulating properties, let's say you start out buying properties on your own name. Family may happen, so that's important because it's impacting cash flow. It's impacting the tax benefits you're getting. You may cap out in terms of how much tax relief you're getting for owning investment properties. Whilst we strongly advocate you don't use tax as the incentive to invest, we need to use the money that's readily available to us, the incentives that are readily available to us as cream on top. Yeah. So there is a natural cap in terms of how much tax benefits you can claim back, because it's totally reliant on how much tax you're paying. And so the diversification needs to happen there in terms of, there's some that are tax benefit heavy. There are some that are cash flow heavy. There's some that, you're saying that, okay, I see the opportunity on this property. I'm foregoing the tax benefits because I see what the true end goal for this property is. Then when you look at all of those things, you then also got one more moving part, which most people tend to forget in the diversification side of things, which is the leases, right? So generally we tend to do just 12-month leases or 6-month leases. If you've got a larger portfolio, that you'll find that ultimately they all sort of start lining up to within 1 or 2 months of each other, because generally your progression of buying is usually that way as well, right? So it's really important to then start staggering the leases as well, in terms of when they're expiring, so that you don't potentially have 2 or 3 properties vacant at once, or 2 or 3 properties that are out of lease, and you're going backwards and forwards trying to negotiate with the tenant to try and get back into a lease. And if you had them as, okay, the leases are expiring probably 2 months apart, it gives you better play. So if you've missed the boat on one, particularly if you've got the same property manager, right? And if you missed one property, you're likely to miss all properties in terms of lease renewals, especially if they're coming on at the same time. Yeah. And one of the things, and this plays hugely, thinking about ours, this plays hugely in today's market, because one of the things when employment is at an all-time high, you'll find that there are 2 industries that suffer the most attrition, where people go and start doing easier jobs. So once the construction industry, so your roofers and tilers, they go and start driving forklifts, and your property management industry, where they go and start doing easier jobs outside of the industry because there's so much employment available. Yeah. So generally, the juniors get promoted to seniors, or the seniors that are remaining now, instead of managing 200 properties, all of a sudden they're managing 400 properties. Yeah. So the quality drops, right? And if you haven't got this diversification dialed in, the flow and effect is that you will miss the rental increase windows that you have if you've got everything sort of going online at the same time.
I wrote an article for Real Estate Business. Well, sorry, I was quoted in an article in Real Estate Business recently around this particular point, and sort of and I want to ask you about, do you need to diversify property managers as well as whatever? But the point was, everyone talks about the rental crisis, the affordability crisis, the cost of living crisis. I argue there was a crisis in property management. Yes. Because exactly what you're referencing there, and actually only this morning looked it up. There's over 1,000 jobs on Seek for property and leasing managers, residential property leasing managers, and the whole on Seek, the whole amount of ads in the category of real estate was like maybe 2,300. So nearly half of all jobs in real estate is for property and leasing managers. Yeah. And it's a crisis point.
It is a crisis.
It's an absolute crisis point. So, and it's really hard work. It's hard work to do. And to your point is that when there's easy jobs out there where there's less stress and, a lot less of the headaches, they're going to go and do that, which just completely erodes it even further. When 70% of all properties are managed by property managers. It's a big deal. So do you actually diversify property managers? Because there's an argument to say, and one of the things I'm least like about being a property investor is renegotiating rents and managing that, right? Because you've got to do it 60 days beforehand, and there's all these rules now that you're going to do it once a year and blah, blah, blah. I find it really onerous, the admin of it, and every time I do it, I need to have an argument with the property manager where they'll say, oh, we've got a CMA that says this, and then I'll go, well, I've just looked here and here is 7 or 8 properties exactly the same have been leased in that area over the last month, and it's telling me this. So you have this backwards and forwards the whole time.
Yeah.
I find it really fatiguing. So are you better off having more property managers rather than clustering as a
Yes and
diversification?
no.
Yes and no,
Yeah.
They're like an extension of you. So I think once we find a good one, we kind of stick to them. But different areas, definitely different property managers.
It's tough. So that's another layer of diversification.
Yeah,
Leases, property managers,
Yeah.
when they're coming off. And your view around diversification of do you want people on 12-month leases, or are you better off on them on periodic rolling? It doesn't really matter now because...
It doesn't really matter. You can't kick them out unless you've got a really valid reason. That's most states.
No grounds eviction. It's just been tabled and
New South Wales, it's
accepted
coming
in New
online
South
on
Wales.
May.
Yeah.
I think we spoke about this at our Ride on Track event last time, right? Yeah.
So it doesn't matter anymore because...
Doesn't really matter.
No.
Yeah. The lenders, though, perhaps have a better view if you've got in fixed leases.
Yeah.
Some lenders. And also you probably want to look at the fine print of your insurance as well as to whether they treat a rolling lease or periodic as it's known as just as good as a fixed lease.
So there's another thing. Do you diversify your insurance?
Insurance.
It's
Yes.
easier. And I've got a lot of insurance. I think that you suggested we used way back when, and I'm finding they've changed your underwriter and they're a lot more expensive now. So I'm shifting them all. But now I've got 2 or 3 different insurance relationships I need to manage, which again is just...
And knowing the policy as well.
More and more onerous, right? And those policies were pretty good. They were a good insurer. Yeah. Now they're sort of insuring through someone else.
Yeah. And that's part of it, right? So as you look at things in terms of how the portfolio progresses, you do need to look at all of these costs, right? Without compromising the fail safe, right? So there are some properties, some areas where I would not exit out of that insurer. We won't mention them by name, but we won't exit out of that insurer purely because they have probably one of the very few insurers out there that will insure forensic clean on a property, right? But you got to pick your battles, and as an investor, it is within your sphere of action to look at costings every single day to see how you can make it leaner and better.
And just going through this, it just goes to show all the different moving aspects of a property portfolio that you need to think about diversification. And we haven't even really spoken about different states or different. But we've spoken about that at length over the years. So we'll park that. But again, it's a critical aspect of it all. It's a critical aspect of it all. And touching very quickly on structure, diversification and structure can be a real enabler for growing your portfolio. And there's this misnomer at the moment that accountants will write you letters saying that your trust is neutral and therefore lenders won't take it into consideration of the lending. That's getting a lot of oversight and will do. So be very, very careful around that. But SMSS, for example, is a great way to diversify structure. That's normally the first cab off the rank for most people when they sort of tap out and it's not make sense to hold it in your personal name anymore.
Yeah, absolutely. And this is where you're really looking at the holistic picture. And if you're not able to continue buying in your personal names or the entities that you've got, then the self-managed super fund is a good avenue. However, you don't want to jump into it unnecessarily and too early. You need to really do your research in terms of how much you really need to get a quality asset in the portfolio and not buying for the sake of buying because everyone else is buying in the SMSF.
Well, there's still a lot of sort of spruikers skulking around that SMSF area as, these sort of inverted commas property clubs out there will sort of, hype it up and tell you all the reasons why you should be doing it. So again, be careful. Now, let's go to the next D.
I wanted to, just how people set up trusts and all these other entities. too much early in the piece, if because these are exciting things to do, and whether they really need it or not, based on their goals, what they're trying to achieve, and whether they do really need to have a trust structure set up for their investing purposes. These people are making, people jumping in and making these structures. Yeah. So either too early in the piece, or whether if it's not required
There seems to be a
either.
trend now, and some of the accountants I'm speaking to, where they'll have people coming to them saying, I want to set up a trust for my first investment. And they're
Yes.
like,
Why?
Why are you doing that? And there'll be an argument, well, someone's given them that advice. And maybe on certain occasions it makes sense to actually hold all your properties in trust.
Yeah.
But I'd say that's probably the fringe case rather than, I'm
The
going to build a
majority.
massive portfolio, therefore I need to start investing in trust. Well, you only need to look at the statistics, and most people don't build massive portfolios.
You need to look at the whole picture, as opposed to it's good and sexy to own properties in a trust because it's asset protection, all that. My understanding of trust is it's a Trojan horse, right? The attack can come from within. So there are things that you need to look at, and then you need to look at obviously the tax consequences of it as well. So when you bring it back to diversification, you do also need to have diversification in terms of advisors as well, right? So you may have outgrown your broker, you may have outgrown your accountant. So you need to look at where that advice is coming from, and have you really gone beyond their expertise, or are they just as dialed into this process as you are?
That happens. I think it's a really good point. Diversification of advisors is key, and it's quite hard for people to sort of move on from their advisor because it's a trusted partnership.
People don't like change.
They don't like change, and it's like, well, there's a sense of loyalty and all that sort of stuff, and I completely get that. But sometimes, in order to move, you just outgrow them. They might not have that skill set.
Yeah, that's right. Or you're no longer an ideal client for them, right? Because they've grown.
Yeah.
So there are things that you need
and
to
they
take
dump
into
you.
Yeah, that's right.
You're trying to tell me something.
Shock horror.
Yeah. Oh, God. So let's talk debt, Reshmi. So it's the next D.
Oh, well, we
Is
have.
debt good?
That is good.
Yes.
Debt is very good. Okay, yes, debt is a useful tool to get you to where you want to go, but just have to make sure that you're not too top heavy, and so you have to maintain your debt and the cash flow. So I guess your cash flow then impacts everything else that you can do in your portfolio. And this is where the restructuring of the mortgages come in. You have to really hone down, look at your... you always have to look for better debts that are out there, the better products that are out there. So you have to be very always on the lookout for good loan structures, loan scenario. And as we say, interest rates are not the deciding factor, but as an investor, if you've got multiple properties, you always have to still keep looking what else is out there and outweigh with the cost of refinance if you had to. Whether it's worthwhile refinancing, are you really saving in the long term, or is just a refinance for the purpose of reducing the amount, the number on the interest rate, as it says. So yes, that's great, but you as an investor, you've got to always keep looking for the best out there.
Yeah. That's a good point, because most investors I know that the interest rate is probably a second or third consideration in assessing it. It matters if you already have the debt and you want to make sure that you're getting the sharpest rate possible from your lenders. And we've spoken about it before, sort of spending the time to actually negotiate on your interest rates before the need to refinance, just to keep them honest. But a lot of people have a misconception about debt. They think it's bad. If you're using it for the right purpose, it's good, but you'd be mad. I don't know if you see it. Does every single person that use right property use a broker, or do some people go direct to the bank?
Some still go direct to the bank, and for some they are, it makes sense to go to the bank because they've got a relationship banking, they've got a business, and there's less questions, less paperwork asked for that person.
In a certain professions, the banks look after them
like
better.
Doctors, they get a free pass on another mine, all
That's
that
right.
sort of stuff. Who would have thought? Why? They seem to be more ethical than journalists and property strategists.
I think property strategists and journalists should be at the top of the food chain, right?
for ethics.
Yeah, that's it. Yeah, but this is raises a really important point, right? So, and it ties back into diversification as well.
Yeah.
you could be that you're starting out initially, you didn't know these things, right? That you're a psychologist and you could actually get 90% no mortgage insurance. Your broker didn't know that. So you're now diversifying out onto better brokers. From there also, if you're looking at it from a debt perspective also, it makes sense that every 3 years you're really coming back and reviewing all of your loans, right? Regardless of how sharp your rate is, because this is where you get caught up paying loyalty tax to the bank.
Yeah, and I do it every now and then. I hate it, but I do it where I'm just I'll spend a day just to fight with banks and try and get and expect to sit on hold for a long time. Right, it happens. To try and work it, and there's many ways around it. You know, you've shared them beforehand, like going straight to the what do you call it? The discharge team.
Go to the mortgage retention team, right? Send them a discharge notice and see the phone calls happening back your way. So, short circuit the process.
Well, I spoke to someone, and I think they're a client of yours, who has a reasonable sized loan. You know who I'm talking about, who try and negotiate. They went, no.
Yep.
You refinanced everything for someone else. They got the discharge form. They called up and said, let's do business. And you went, no, mate, too late.
Too late.
So it happens. But you've got to be on it. Like, people think property investment is a simple, easy, straightforward, passive investment. It's not. You've got to be prepared to work hard every step of the way and also fight hard, you know, to get everything you need to get, right? It's hard work. So that's the debt side of things.
So with the debt also, when you're buying initially, let's say you've used money out of equity of your home, right? This is an ideal time to now reshuffle the debt, do a little bit of debt recycling so that the money that you've used, the equity you've used out of your home now sits wholly on the investment property if the loan to value ratio allows for it. So that it becomes cleaner from an accounting point of view. At some point in time, you're going to sell so that the water is less murkier at that point in time. And then also looking at it from ease of operation point of view, right? If you've got everything sitting in the one account, all the debt for that property sitting in the one account, your accounting all of a sudden becomes easier. Your decision-making process is really done on the real numbers as opposed to, okay, that property has got a loan of 500,000, so that must be my cost. People very quickly forget about the deposits.
And where that came from.
And when we get people to sit down and actually do the figures, we have a property tracker for our clients. Most people, if they haven't done the figures religiously, become very, very surprised as to how much the portfolio is actually costing them when you take the tax benefits away, when you take all of the business of life away and bring it down to actual figures. They're very surprised as to what the property is actually costing.
And this goes to the effort you need to put into being organised, right? And this is what the key to investing in many ways. We're talking about debt, but is organisation. So I don't know how many bank accounts would you have, because no doubt you match and offset with every, so each is its own separate operating engine. Do you?
Yes and no. So I'm constantly refinancing when I can, and when the banks like me, because it goes through those phases where the banks don't like you, right? Because it doesn't sit in their appetite or doesn't sit in the credit policies, or the economy is not good for a professional investor, right, or a successful investor. So one of the things that you'll find is the banking system actually punishes investing success. Right, so one of the things that when you hit this level, one of the things that the bank starts throwing back at you is to say that you're too rent reliant. But that's the whole purpose. I want to be rent reliant so that I can not be reliant on my PAYG. Now it has its pros and cons, obviously, right? If you're totally rent reliant to the point where if the rents don't come in 1 month, you're in dire straits. That's a bad portfolio.
That's diversification from the bank's point of view.
That's right.
They want multiple income.
You'd like to think that your rental income, it's really, if you're at scale, it really dilutes the risk.
It does.
Right.
It does.
If you got one rent, you lose it. You're stuffed. If you got many.
So with this, when we're talking about that, we're also talking about cash flow of the portfolio as well, right? So trying to reset it back to interest only, if you're still in that accumulation, and maybe you make one property a consolidation property where you're starting to pay those loans down. This is where mindset would come in as well.
Now I'm just thinking about the time when we would shifting our debt, like setting up the loans in a way where we were focusing on paying off a property. That's this.
Yeah. So this is where you start doing a snowball effect of paying down mortgages, right? So first thing is we need to correct the negative cash flow to back into tolerable limits, right? So it's no longer giving the banks a hard burn. It's also no longer impacting your lifestyle. So how would we do that? One is restructuring the mortgages. A really simple thing. So, and a really good example of this, say if you're investing in an SMSF, right? And we know that with the SMSF, when you set a mortgage, once you set the loan, you can't actually increase it.
Yeah.
So the idea is you'd go to 80% loan to value ratio straight off the bat, right? But you're paying higher interest rate when you go to 80%. So when the property goes up in value, you go back to the same bank, get them to revalue it and recognize the lower loan to value ratio, and therefore your rate instantly drops to buy about 0.75 to 1%, right? So that's significant within the SMSF. You can do exactly the same outside as well. So you're correcting that. Then you're also going back and perhaps building a granny flat or a secondary dwelling on one of the portfolios to wash out even more of the negative cash flow. And because you've built brand new, you're also now picking up fresh depreciation. Yeah.
On the granny flat
On
stuff.
the granny flat side, yeah.
How, and we'll talk New South Wales as an example. So all those changes recently in the zoning,
Yep.
It's really sort of enabled a lot more multiple dwellings on.
Correct.
So I think universally now you can, if it's a certain size, you can put granny flats on.
Yes,
stuff.
that's right.
So can you just explain that a little bit more?
Look, it's always been the case in New South Wales. New South Wales was the front runner in terms of granny flats, right? So it became a thing during the GFC, right? Because interest rates were high, so people were looking at alternatives. So they realized that you could actually put a granny flat on a 450 square meter block, right, with a house in the front. Why you do that? I'd sort of question. Right, because you're really squeezing it on and therefore impacting the liquidity of that property. From a owner occupier point of view. But if you're close to the city, 450 is a big block, right? But if you're out in the middle or outer suburbs, it's a small block, right? So you need to take that into account. But now, if you look at across all states, pretty much every state now allows for you to build a granny flat and rent it out independent of the main house, right? Provided you go through the right channels. Yeah. But this is where prudence comes into account, because the granny flat is going to cost you, a 60 square meter granny flat is going to cost you around 250,000 these days to build.
60 square meters is 250K.
Yeah. Easy way to.
I remember when they were like 70 grand.
70 to 120 grand. Yeah.
Those were the days.
So if you look at building cost right now, it's between $2,500 to $3,000 a square meter. Yeah. So they're in your cost. You've built the same granny flat. If you built it in each state, it gets different rents, right? So as an example, in Victoria, if you build a granny flat, right, and let's talk middle suburbs, middle ring. If you built a granny flat there, you're likely to get about $350 as a rent. Yeah, still spending $250 to build.
That doesn't really make sense.
You brought that same granny flat into middle ring New South Wales, middle ring Sydney, you're getting $450 to $500, right? You took that same granny flat into Brisbane, depending which side of the bridge you are. You're getting either $500 or $550. Yeah, and take that to Perth. You're getting $450, $480 to $500 depending on the suburb, right? So where you build at this point in your portfolio, you need to pick the best bang for buck to wash out the negative cash flow. Your depreciation will be still the same, whichever state you're building, right? So really what you're talking about is the cash flow, making sure that we get the cash flow right and choosing which property to build a granny flat on.
So I imagine that's highly connected then with direction, which is the third D.
That's right.
Like what direction are you in? When do you move? When do you change? When do you shift? When do you rise? And the right direction at the right time.
Hence, Right Property Group.
The Right Property Group. That's RIGHT. Are you still happy with the name Right Property Group? Have you guys moved on from being the Right Property Group? You're still right?
I don't know.
RPG, it's very modern these days.
That name is back when we were back in 2001. We were deciding on the names and all that, and it was Right Group Australia, and then we changed it to Right Property Group, and now we're really looking at we do more than just property. We just do more than just buyers agency.
Point, right? Because even like. This conversation is more than being a buyer, like a buyer's agent. It's true property strategy, right? Like, a buyer's agent, you go, and it's probably, I put a lot of thought to this, and I'm going to work on it a bit. Like a buyer's agent being, I want a new home for my family. I wanted to have a swimming pool. I wanted to be near a beach. Can you
The
go on
criteria of the property.
That's a buy. I'll go and find you that
Yeah.
specific property. Like it's
Save
very
you time.
different. Yeah.
See, right from
Very
day one,
different.
we've been like mentoring, and our mentoring comes for free with our buyer's agency service. So, we've got the buyer's agency, which we do.
It's
but
just the fulfillment.
It's
just a
yeah.
fulfillment. Just one bit of
But
it.
it's,
Yeah.
yeah.
But most of it is direction because you can't do anything
Yeah.
right.
Yeah.
You
See,
know,
at
unless you have the
this
right direction.
phase phase of the portfolio, this is where people go wrong because we are then there's so much noise out there, right? And we've had a bit of success behind
We've had a
us.
bit of success. We kind of know what we're doing. Okay.
So easy.
Yeah.
Can't
yeah.
go wrong.
Yeah.
That's the biggest thing is like when someone starts betting on the ponies and they get a couple of good wins and they think horse racing is like, they're a genius. So I know so many people who just by luck or fortunate in when they start investing, they just luck out. Now, I'd probably put myself into that, but I thought our experience in Western Sydney was going to be emulated every other part of Australia at the speed and scale at which it did.
Oh, I
And it
remember
did,
the
and it
conversations
did.
about the Brisbane properties.
Yeah, you're going, come on, mate, what's going on? I told you they come, good Victor. I told you they come. You know what I mean? Like, so you just go, you need to have a sense of normalisation, right? And that will help sort of shape your direction. So how would you sort of frame the direction bit? It's just you've got to make the right calls at the right time.
Well, yeah, this is if I bring an example back into my own journey, our own journey, right? So we had a bit of success at quite a few properties in our belt, and then in year 2000 we decided to try development.
Is it the land you're talking about in the?
Oh, yeah, that's another one. No, we won't even go there. That's for too many scars.
So many problems,
Yeah,
so many
that's it.
mistakes.
But
Yeah,
we attended.
We thought we knew what we were doing. They were early days. So
In the initial stage, we're going more buy and hold renovations and all that. So we thought, you know what, I can see that there's massive equity to be gained through doing a development, and we decided to complicate things a bit because we thought we were bulletproof, right? So we went and bought a DA-approved site in Queensland, in Redcliffe. This is where we were supposed to, just to complicate things a bit. Now, understanding in 2000, we still dial-up internet.
That's 25 years ago.
I know. Don't
sounds
say that
like,
out loud.
Wow, wow.
And this is where I'm running a business. I'm also trying to do development, trying to systemize things on the go. And that took 2 years of our investing life away from us, right? Because
You didn't do anything. You were stuck
well,
for 2
we were
years.
stuck
You still-
because I made some rookie mistakes, like we're supposed to lift the house and shift it sideways and plonk it and create another space for bringing another house, existing house in there.
Simple concept.
Simple concept, right? Worked perfectly on paper. But I made the rookie mistake of lifting the house up and shifting it sideways before the finance was in place.
Oh.
And it took me 2 years to then actually self-fund it and get it
So they
done.
wouldn't finance it.
No, because they're sitting on drums.
It's
Yeah. So this is where you sort of at this stage of the portfolio you think you're bulletproof, right? You think you know everything. You think everyone's buying Perth, I'll buy there because I've done well in Perth. I'll continue buying there, or I've done well in Victoria before. I'll buy there, not taking the negative cash flow impact of buying in Victoria.
So buying in an area, you've got comfortable and you think that you can maintain yourself in that comfort level, but the market may have changed. Times changed and it may not be the right place to buy anymore.
Yeah, one of the biggest detriments to a property investor's ego, right? You know, when you think you are bulletproof.
Yep.
Yeah, you see it happen.
Yeah, and then you've got all of this digital noise now around you, right? You just jump on Facebook, Insta, TikTok. You look at all of these people saying, buy this, do NDIS, do this, do that, right? And it all looks really, really easy and really lucrative. And because you're actually at this point in time hurting a little bit from your cash flow, you're trying to jump on things to solve the cash flow issue without taking a fundamental approach. And that's where you get wrong, because you're not taking into account, okay, is this next move going to get me closer to my goal? Or is this actually just action without a result? Or is this action that'll actually take me back to where I started?
Very complicated. It's hugely complicated. So it all comes down to then, I would imagine, risk minimisation.
Yes.
Yes.
Which is probably highly connected with the last D, which is
Which
the
is the
defense.
defense.
How do you
yeah.
defend what you've created?
Yeah.
Yeah.
And defense, some people will say, the best defense is offense, or the best, come up with whatever sort of theory you have around it, but a lot of people don't think defensively. You know, particularly if they're vulnerable, and that vulnerability being an ego or a sense of bulletproof. You know, it's you've got to make sure you've got the gates locked.
Mm-hmm. Yeah. Well, if you look at it, and no secret, I play a lot of soccer, right? So when you start losing a match, you automatically psychologically start defending more, right? Whereas that's the time to actually be more offensive and try and equalize or neutralize the advantage. And if you bring that to a portfolio, at this point in time, you're actually negative cash flow in most cases, depending on how the portfolio is set up, what the goal was, and so forth, right? But in most cases, it's negative. And so the natural tendency is to start cutting down your costs, and you start ignoring things that really matter, right? And not putting those measures in place, taking a structured approach. So simple things like insurance, right? So when we look at it, and we go through this all the time, right? Look at insurances in terms of the biggest one is income protection. Right?
So it's your ability to, keep earning your income and you're protecting your income.
So if you look at, what are the two components in this equation that actually bring in the income? It's you, right? So ability to earn in, even if you're self-employed, right? It's your ability to bring in the bacon.
Income,
So and then the second one is the property's ability to bring in the income, right? And the third is the tenant's ability to bring in the income, right? So we need to ensure all three. So we're talking, of course, income protection, right? And if you've set up self-managed super fund, get some really good advice. Maybe there's some efficiencies there you could pick up. Then you look at it from the house, the unit, that's getting me income, so I better insure that, right? So building insurance itself. And then the third is the rental cover, which is the tenant's ability to pay you income. So if they default, if they do a runner, then the insurance actually kicks in. Landlord's insurance actually kicks in, and this is where the building and landlord's insurance is where you don't scrimp. The income protection is where you don't scrimp, but be mindful that it could be very expensive if you're starting too late, right? So for you, sir, it would be quite a lot more expensive, whereas I'm much younger, so it'll be much cheaper.
Well, I reckon I have got my first policy. It's not income protection, but it's a sort of similar sort of outcome policy because I'm self-employed. I've probably had that for 20 years, right?
Yeah. And it's something that you hope that you never have to claim on.
And if you get it young, it's
cheaper.
It's a lot cheaper and stays cheaper.
Yeah. Mind you, the income protection policies have changed substantially in the last 2 years. So you speak to your advisor. And then, of course, we need to look at the ability to retire the debt. Right? So if you've
just sell everything,
so that's the life insurance.
So life insurance, people insure their car, but they don't insure their life. Right. And that's really important. So again, you don't necessarily want to pay all of these out from your normal PAYG income. You need to sit down with the right advisors and look at efficiencies as to how you can have all of these defenses in place without significantly impacting your cash flow.
The defense is interesting. It's very much mindset orientated.
It is.
And I know my sort of organic position would be defense often rather than offense. And I always swing from defense and then go, it's all okay. And then that really empowers me to be offensive. But my initial thing is defense, then offense, rather than offense and then defend it. And it just depends how you really wired. And the defense being considering everything in the balance, you've got most things defended, so therefore you can comfortably be offensive on the basis of if it doesn't go right, you've got fallback positions.
Yeah, absolutely. And this is when you're starting the investing, right? And property criteria and looking at what types of properties, where you're buying. You got to always look at it from from a prospect that life will go pear-shaped at some point in time. We've got no control over that, right? And can we liquidate our position to a degree, whether it's all or some properties, to then be able to reset our cash flow, reset our capital, give ourselves some breathing space. And if you take that approach to say that everything will go pear-shaped in 18 months when you're buying your next asset, if you address that first to say, okay, here's my exit strategy, here's my defense on this, not talking insurance, we're talking actual get out of jail, right? That's, if you took that approach, you can't go wrong.
So tuning into all of this, Reshmi, you would be, people wouldn't think you were mad to think that you shouldn't invest in property because it's not easy.
It's hard.
Like, we're talking about some more sophisticated things here, and,
Yep.
and building a portfolio, not just one property, right? But it's not easy by any means. There's so many things you need to consider and think about, and there's still a lot of unknowns. You just
There
don't
is.
know.
It's true. It's true. You have to be fully involved and you have to be immersed in it. It is a business. You've got to treat it like a business, and how you have to know your numbers. You have to look at the health of it. That's the same thing you would do with property as well, your whole portfolio. One thing I wanted to mention was the insurance, as you said, was the ability to get your rent and the ability, how our property, we had that Esplanade one. That was a very good example of an insurance ability. Even though we didn't have the tenant in there, we continued to receive our rent because there were issues with the property.
Yep.
So, and it was a very long time. By the time we
You've
got
got to keep
to
on
fix
top of
it.
insurances. And
Yeah.
I remember back in the day, I used to get little nudges from your staff saying, Phil, you haven't paid this policy. Mate.
Yep.
Like, and always go, yeah, well, that's the day it's due. And typically that means the policy's in place. So, they're not going to cancel it probably for another 60
Yep.
days.
We've had
I'm sure you've done the same.
we've had scenarios where we missed paying our insurances,
Yeah.
where we didn't realize the property was not
Uninsured.
insured.
Yeah. It happens, right?
It happens,
Yeah.
especially
So
with
you've-
multiples.
Yeah. So you've got to make sure you're checking your expiry dates and all the rest of it. So if you've got multiple properties, you've got to have it going.
Got to build out your own way to administer it. Because it's you think about all the different renewals, right? Lease renewals, insurance renewals, interest-only renewals, fixed renewals, blah, blah, blah. It's complicated.
Yeah.
So don't invest in property. That's it.
Yeah, unless you talk to us.
Unless don't invest in property unless you speak to the right property. They'll make everything okay.
Yeah.
We'll hold your hand through it.
But the thing is that you can't be expected to know all this stuff.
No,
No.
it's a journey.
You've
It's a
got
journey.
Yeah.
30 years of investing. I've been
Oh my
probably
gosh!
out
Don't
for-
say that.
probably
It is.
right?
Yes.
Yeah, it
yes.
is.
I've been at half the time you have.
Wow.
You guys had
It's a long
half
time.
the time. Yeah, all the advantages. That's why you're so far more advanced than me. I'm just struggling property investor.
I'll listen to you.
It's true. It's true. Can't even afford my insurance.
Oh, wow.
It's, but there is times where I just go, stuff it. We've spoken about it before. I'm sick of it. Don't want anything to do with it.
Yep. Yeah, we've had that conversation.
Yeah, but then you look at the share market right now, and it's been decimated. Like, imagine it's like I'm not sitting with my head in my hands going, I've lost all the value of my, properties. But it's
Sometimes
very
I feel
volatile.
like doing the same thing with property. Like, okay, I can be a property, like a fund manager. Like, so here you go. This is our property portfolio manager. Manage the portfolios.
Too
Have
much.
another business on the side.
Too much.
Oh,
Stop.
gosh.
Just sell everything.
That's it.
There you go.
Yeah. Go to the Bahamas.
Go to the Bahamas.
Yeah.
You'd be happy in the Bahamas, wouldn't you?
I don't
See
know.
you swanning around in a wine shirt and, whatever.
I don't know.
Drinking pina coladas. Anyway. Well, thanks for coming in. No, it was good. That was good. 4Ds. I think we've really broken them down and given people quite a lot of food for thought. Maybe complicated them or posed more questions than answers. So probably best they talk to you guys to any questions, queries, uncertainty.
Questions at right
Probably
property
sitting there
group.
with their heads in their hands going, what have I done?
Yeah.
It's not too late.
Yeah.
So you don't need to be a client of yours in order to talk to you about all this stuff.
No. So if you've got a largish portfolio, we do have a service where I actually do a portfolio review for you.
Do you charge for that?
Yes, I do.
Okay, fair
Because
enough.
it does take a lot of time because I need to dial into each property and see what the merits, the pros and cons of it, and what the opportunities are on the properties.
I would expect to pay for that. If you weren't paying for it, I'd probably question
Yep,
Yeah.
the advice.
absolutely. Yeah,
To be
the most
fair.
expensive advice you'd ever get is for free.
Yep. But it's not like a huge amount of money, right?
No.
But it's enough to cover your time.
Yep.
Yeah. Fair enough. So you've got a portfolio you think is pretty good. Then you tune in this and you're going, I'd just like a second set of eyes on it. You guys do that.
Yes, we do.
Okay, and you provide recommendations
Correct.
around that.
Yeah.
And those recommendations wouldn't be contingent to using right property. You
No,
go away and do it yourself,
no.
right?
We might go back and say, look, you need to restructure your debt this way. You need to perhaps offload this property or look at developing this property because the zoning's changed there. So because I can dial into all of those things.
Yeah, okay. zoning's changed quite a lot.
They
for
do,
a lot
they
of
do.
people. Yeah. See, I don't have much stuff in rezone thing. That's what I need. That's what I need to talk to you about.
Bit of diversification.
Yeah. You know where I'm thinking as well. There's lots happening there. But anyway.
It's hard to get those.
I'm not telling anyone where it is.
Yes.
It's my special hotspot. But yeah, there's not a lot there, right?
Yeah, down like Burke.
Yeah.
Yeah.
You go to Murrumba. Mining towns, where is that? Well, thanks for coming in. That's good. So, best way to contact the team, Reshmi?
Questions at rightpropertygroup.com.au.
That's where to do it.
That's it.
Or just jump onto the socials.
Find you there. And when's the next Right on Track? RIGHT.
Yeah. Well, you'd register your interest on our website.
So
and when
you choose whether or not you get to go.
Yeah,
So
because
why I
it
never
depends
get
on.
invited.
Depends
I'm getting
on.
blackballed.
That's it. No, you're a blacklisted client.
Yeah,
So. Ask too many questions.
Yeah. It's a pesky bloke. So just register. You can find it online. Okay, good. Well, thanks for that. So episode 4 of our series on Design Your Decade. What are we going to be talking about? Any thoughts yet? Any sort of little teaser for everyone?
We'll be talking about the different investing methodologies and then what happens in consolidation in the next few podcasts.
All right, very good. Look forward to it. Rightpropertygroup.com.au. You can track these guys down there and ask them anything. Call them up. I know there's a process in place.
Yes.
And so anyway, go and chat to them. I'll sort you out. Thanks for tuning in. I do enjoy recording this podcast. We've been doing it for a long time.
10 years.
Probably nearly gone.
Oh, gosh.
Yeah. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.